When missiles fly in the Middle East, the tremors don't stop at the borders of Iran or Israel. They ripple through your electricity bill, your grocery aisle, your stock portfolio, and your currency exchange. This isn't just war, it's a rewiring of global economics. Welcome to FluxFolio Finance. Let's journey into how this 12-day conflict became a catalyst for economic aftershocks that the world may feel for decades. The war did not begin with a bang. It began, as history often does, with silence, with shadows. A scientist found dead in Tehran. A radar facility in Isfahan mysteriously ablaze. A cyber attack blinking power off in Tel Aviv. Then suddenly, sirens, fire, dust, and sky. Missiles streaked across the heavens like burning handwriting. Jerusalem, Beersheba, Isfahan, names that belong to prophets, now branded into breaking news. And with every explosion, not only buildings cracked, but market confidence, energy stability, and the delicate fabric of global trade. Within hours, oil began to speak its own language. Brent crude surged, not because wells were destroyed yet, but because fear had returned. And fear is expensive. In this world, price isn't dictated by supply alone. It's shaped by psychology. The possibility of a Strait of Hormuz blockade, or just the hint of Iranian retaliation, is enough to send futures screaming. Traders remember what most people forget, that geopolitics isn't a separate story. It's baked into the cost of your next Uber ride. It's in the margins of your groceries. It's etched into your central bank's decision whether to cut rates or raise them. This war, unlike so many others, hit a world already leaning on the edge. Post-COVID dislocation, climate-disrupted harvests, interest rates still brittle from inflation fights. And into that fragile scaffolding came fire. In Europe, governments had only just begun to recover from their dependency on Russian energy. Now, as pipelines quieted, the sound of tankers across the Suez grew louder, and with them, the price of uncertainty. France, Germany, the UK, states that rely on the timely arrival of LNG from the Gulf, were watching tankers with more anxiety than diplomats. And in Asia, Japan and India began recalculating currency reserves, weighing strategic stockpile releases, bracing for the next fuel invoice. Every nation is an oil importer when war touches the Gulf. And the United States? Gasoline prices climbed, not sharply, but perceptibly. Enough to change sentiment. Enough to shift voter confidence. Enough to make the Federal Reserve pause again on its plan to ease rates. Because inflation no longer flows only from policy, it flows from missiles. Even a short war, a limited exchange, becomes global in a tightly wound system. Every shipping lane is a vein. Every pricing contract is a nerve. And every bomb detonation becomes a pulse through that anatomy. Yet the market did not scream. It whispered. Stock markets held, surprisingly. Safe havens like gold, and the dollar rallied. Bitcoin surged in a strange tremolo of digital belief. Volatility rose, but not panic. Because in a world grown numb to chaos, capital seeks the familiar. But here's the danger. Stability can be deceptive. Markets aren't calm because they are safe. They're calm because they're cornered. Because what choice does liquidity have in a world where even neutrality is punished? What choice does capital have when missiles fly near oil fields? Investors aren't choosing optimism. They're choosing inertia. And yet, beneath the charts and price movements, a deeper change is taking place. The weaponization of energy, the algorithmic memory of trauma, the fragile trust in roots, alliances, and reserves. Iran's warning to close the Strait of Hormuz may never materialize, but the memory of that warning will linger in contracts, in insurance models, in risk calculations for years. That's the power of narrative violence. It persists even in peace. This war was not the largest, not yet, but it was symbolic. a signpost on a road that leads not just to new geopolitics, but to a reshaped economic world. To understand the true cost of this war, you have to stop looking at the battlefield and start looking at the spreadsheet. Because the missiles may fall in silence, but the echo travels in numbers. This wasn't just a regional flare-up. It was a mirror held up to the global economy. And in that reflection, the world saw its own dependence on routes, on resources, on routines that no longer feel secure. Let's begin with trade. Ships don't move on courage. They move on confidence. And when that confidence cracks, supply chains tighten like arteries in a panic. Insurance rates on Gulf routes doubled. War risk surcharges tripled in hours. Ports stalled, not from damage, but from doubt. And in that delay came cost. Every extra day at sea is a delay in delivery, a dent in inventory, a ripple in inflation. And inflation is a ruthless tide. It seeps into everything. Germany saw power prices climb. India's rupee weakened under the weight of fuel imports. African and Southeast Asian economies, already strained by debt, felt the bite of more expensive energy and fertilizer. Because when LNG routes are threatened, it isn't just heating bills that rise. It's crops, it's factory uptime, it's the plastics that wrap every product you buy. Even peace becomes more expensive to preserve. And China stood still, but watched everything. With over 40% of its oil coming through Hormuz, Beijing did not blink, but it flinched inside. The war reminded the Politburo why alternative corridors like the China-Pakistan route or Russian energy pipelines are not optional luxuries. They are existential hedges. They are plans not just for trade, but for survival. Beijing called for calm, not because it feared war, but because it feared disruption. Not missiles, but missing cargo. And here's where the story turns economic philosophy on its head. Because in theory, markets price risk. But in practice, markets chase stories. And the story that unfolded here was not about who won the war. It was about how fragile the peace had been. Currencies followed that narrative. The dollar rose, not as a symbol of strength, but of last resort. Gold gained, reminding us that in every era, there is still one currency immune to lies. And Bitcoin, curiously, joined the rally. Not because it's safe, but because it's untethered. But the most disturbing signal came from the bond market. US Treasuries, long considered the world's bunker asset, did not rally. They wobbled. Because war brings oil shocks, and oil shocks bring inflation. And inflation brings the enemy of all debt, higher rates. So even as investors fled to shelter, the shelter itself shook. And that's the hidden cost of modern conflict. It erodes the very definition of safe. Meanwhile, policymakers were caught in a cruel dilemma. Do they stimulate, or do they defend? Do they fund heat or hardware? Do they calm markets or contain enemies? Even rich countries face hard choices when the guns of geopolitics drown out the calculators of central banks. Sovereign debt balloons. Trade corridors narrow. Growth forecasts flatten. And under it all, confidence, the most fragile currency, leaks away like air from a tire. And the pain isn't always visible. It appears in delayed infrastructure deals, in frozen hiring rounds, in central bank silence, in the slow grinding gears of a global machine built for frictionless motion, now seized by hesitation. The Israel-Iran war wasn't the collapse. It was the rehearsal, a dry run of what happens when regional instability meets global interdependence. Even after the ceasefire, the psychology lingers. Supply chains may heal, but they don't forget. Pricing algorithms may normalize, but they embed the trauma. And risk models, once updated, rarely downgrade again. That's the new world, one where every spark of conflict leaves a scar, and every scar becomes a line item on a balance sheet. Because the battlefield isn't just land and blood, it's data. It's oil, it's freight insurance, it's sentiment. And in this modern war, the front line stretches through your paycheck, your power bill, your pension. Thank you for watching FluxFolio Finance. If this gave you a deeper lens on global risk, let us know your thoughts in the comments. Tap that like button if this opened your perspective. And don't forget to subscribe, because the future doesn't slow down, and neither do we. Until next time, stay sovereign, stay prepared, and keep your eyes on the economics behind the explosions.